Good day, everybody, and welcome to Lesson 8 in the Ben and Boz Narrated PowerPoint series. I'm Boz.
I'm Ben.
How you doing today, man?
I'm doing well. Today,
Boz
was telling me I always say good beforehand, so I made it grammatically correct. I'm doing well today, Boz.
I just wanted you to say something different. So whatever you wanted to say
Mission
was
accomplished.
fine. Mission accomplished. So, all right, well, today we're going to be getting into liabilities, and we're going to touch on present value a little bit.
Jumping on the other side of the balance sheet. I like it.
Yeah, that's true. It's a good point. We're done with the assets now. Now we got liabilities and owner's equity left. When we start with a high level here, liabilities are going to be different for each company and especially by each type of industry. So if we look at Walgreens, first off, drugstore, Walgreens and CVS, the two big drugstores in America.
Retailers, yep.
Retailers, do you prefer one versus the other?
I'm a Walgreens guy, but that's just because there weren't any CVS's where I grew up. What about you?
I was always a Walgreens guy, but now I got a buddy who works at CVS, so that's where I go now. So.
CVS proud, huh?
That's CVS proud. So,
well, what do they got for liabilities?
What do they have?
What do they show?
Yeah, so they're a retailer, so they are going to be purchasing a lot of supplies from folks that are making the drugs and other supplies that way, like a Johnson & Johnson, Pfizer, companies like that. So we're going to expect very large accounts payable for a retailer.
Hey, we see that, right? It's almost their biggest liability that they have on there.
Yeah, absolutely. So you said almost their biggest liability.
Sorry, I guess it is their biggest liability.
Last year it was second place to long-term debt. So, but then they also have a lot of long-term debt. All the stores that they keep opening up, they got to finance those.
That's a tremendous amount of turnover, though. When they have all of those accounts payable, right, all the drugs, that balance is greater than their long-term debt amount, and they're paying that off. It's in the current section, so they're going to be paying that off within a year.
Yeah, so this is in billions, too, so they got to pay off $13 billion to suppliers over the next year here. Now let's compare it a little bit differently for a manufacturer, and I went for a manufacturer here that makes a lot of long-term assets. So Boeing.
Are you Boeing or an Airbus guy?
Definitely Boeing. There was a very senior guy there that is a Johnny and at our school, and he actually gave me my first ever corporate job.
That's cool.
Highly biased toward Boeing. So because of that.
We don't really have a choice as consumers, though.
That's true. Okay.
I guess you could refuse to fly certain airlines that aren't using Boeing-made aircraft.
That's true.
We digress.
We do digress.
That's my bad. Sorry, everybody.
It's okay, but it's okay, man. You can see that Boeing has a similar amount of accounts payable that they're paying for their suppliers. They've got a lot of raw materials in the planes. They got $12 billion of accounts payable. Walgreens had $13 billion. But then they have a lot larger accrued liabilities, and one to point out right here is advances in billings in excess of related costs. So, you have any guesses what that one is, Ben?
It seems like a fancy way of saying unearned revenue.
You nailed it, man. We didn't even talk about that in advance, and you got it. And another big thing Boeing has is a huge amount for accrued retiree healthcare and then pension plan liabilities, and we're going to get to what those are in a little bit.
And so, one thing I like to point out here, two different companies, they have a lot of very different liabilities, and so there's not going to be a bunch of consistency necessary that every company shows the same liabilities. There'll be some overlap, certainly, but it just really depends on different companies, and that's going to set the tone a little bit for the ones that we go through here today.
Absolutely. So, the overview, what we're going to get into, we're going to understand how to account for liabilities, and then we're also going to get into some future value topics and some present value topics. Well, hopping right into it, current versus long-term liabilities. We covered this kind of stuff actually back in lesson 2, I believe.
What they call a throwback. We're doing a throwback.
It's a throwback, but we're recording this on a Monday, so Throwback Monday.
Watch it on a Thursday. It's Throwback Thursday.
That's right. Current liabilities are those expected to be paid off within current assets. And Ben, when you think current assets, you think?
Within a year.
Boom. Good job, man.
Technically, it's year operating cycle.
Yeah, right? it is. So
I think year.
Yep.
It's pretty much the standard.
That's what I say for simplicity. Mm-hmm. Most creditors expect to be paid off within a year. Thus, the majority of liabilities are current. Well, at least that's what we saw with Walgreens there. Boeing had some pretty long-term stuff with pensions and healthcare. I think that's more the exception than the rule then.
Yeah, I would say some of those long-term ones, just in general, they might be bigger amounts, but there's fewer of them. So
that's a good point.
A big loan or a big couple of loans that are going to take multiple years.
Yeah, like if you looked at a company's trial balance, they will probably have dozens of accounts for current liabilities and then just a handful for long-term liabilities, but they'll usually be big amounts. And then those are going to be loans, bonds, leases, pensions, deferred taxes, all items, which we'll get to in a little bit.
I can't wait.
Okay, so let's just start going through them. So most companies have an accounts payable. I think of those as items that are purchased but not paid for right away with cash. So we oftentimes will say that they are purchased on account. They're generally paid off within 30 days. They're not interest bearing. What do you think, Ben? 30 days? You agree with that? Or
just from my experience as an auditor, there's a lot of companies that go longer than 30 days where, say, you're like a Walmart, something like that, or a Target, where you're probably going to be a pretty big vendor or pretty big customer for whoever that vendor is. They might be able to negotiate 60 days or 45 days or things like that. But generally 30 days is the starting point if you can get credit at all.
That's a good point. Most often when company purchases inventory, supplies, services, we saw a huge amount of accounts payable for Walgreens. That's when they're buying their inventories for their shelves. So let's take this example. Walgreens purchases $1,000 of medicine from Johnson & Johnson. It'll make payment next month. So what do you think, Ben? Debits and credits on this one?
Yeah, so when they buy it, that medicine's going to be the inventory for them. I think I can handle it.
All right.
So debit inventory for $1,000. They're not paying right now. They're going to pay later, which means we got that payable. So we're going to credit accounts payable.
How about when you pay it off later?
Well, that's when cash is going out, unfortunately. So I'm going to debit my accounts payable and credit my cash account. And you can see net here. We have a credit to accounts payable, a debit to accounts payable. That one's going to be eliminated. It's turned over. And what's left is we had increased our inventory and cash has gone down.
At the end of the day.
We
got inventory and we're out cash.
Well, at the end of the day, hopefully we sell the inventory and we get more cash.
That's true.
That's the goal, but
that's true.
We're not there yet.
All right. Accrued expenses and liabilities. They're recorded when a company receives services or supplies by the end of the period, but doesn't pay for them until the next period. Oftentimes used with estimates for a bill that has not yet been received. So we talked in lesson 4 about adjusting entries. That's when a lot of these get recorded. We're trying to match expenses with our financial statement income.
Yeah, so here it'd be a lot easier, wouldn't it, to just, we got a bill, so I'm going to record it as an expense at that time. But that wouldn't really be right. It'd avoid our matching principle that we talk about, matching expenses to revenue. So at the end of the year, we got to look at everything. What potential expenses could we have incurred that we haven't yet received a bill for or that we haven't paid for yet? And then based on that, we're able to record our expense and liability and also match our expenses with the income.
Exactly.
So life is good, man.
Yep, exactly. So like Walgreens, they use electricity during the month of September. Let's say it's $2,000. They're not even going to get a bill until next month now, but the fact is they use that electricity in September. So what would you debit and credit on this one?
So for this one, some sort of expense that covers electric, usually it's called utilities expense, would be debited, and then I would credit utilities payable.
Right.
And then when I actually pay it off, just like the one before, I'm going to debit the payable, credit the cash for $2,000, and now everything's good. Recorded the expense in the proper period, and doesn't mean we have to pay earlier just because we recorded it earlier. Still the same due date, but now our financial statements will be accurate.
All right. Income taxes payable.
I'm going to let you do that. You're doing all of them. I'm going to let you do this one for sure.
I am the tax guy. So tax expense, you want to record it when a company earns the income and not when the cash is actually paid to the government. Those can be very different, and that's beyond the scope of this PowerPoint, but you learn about that more in a tax course. So let's say that Walgreens earned pre-tax income of $6 billion in its most recent fiscal year. That is actually true, and then the new corporate tax rate is 21%. The debit in that one, you would multiply those together and debit income tax expense for the $1.26 billion, credit the income taxes payable, and then when you actually paid off those taxes, then you would debit the payable and credit the cash. And again, we're recording the expense in the period, matching it against the income regardless of when cash is paid.
Starting to notice a pattern, boss.
That's pretty much it. The first entry, an expense and a payable. The second one gets rid of the payable and also gets rid of your cash.
Cool. Let's see if it holds true for compensation.
I think it's going to. So, but
I think so too.
Yep. But so compensation. So companies record compensation expense and the period when it was earned. So really, when did the employees earn the compensation from the company?
Yeah, this happens, and we're going to see it on the next bullet point here. It happens at year end all the time. Companies have to make an estimate. What do they owe their employees at year end if the day that they actually make their next payroll isn't the same day as year end? There's going to be some sort of gap, usually, where companies still owe their employees money.
So I think like at our college, we get paid twice a month on the 15th and the end of the month. So we don't have the situation where we've worked and they pay us the next month. But a lot of...
For salaried employees. But what about, I guess, even hourly too, if they don't work at all. They get paid on the 31st. But
a lot of businesses, they just pay every 2 weeks. So they might pay on December 27th, and then maybe people work a few days, but they won't get paid until early January then.
Or even if it is hourly employees and maybe your payroll is like a week behind the hours that report for when you turn in your time card. Give the payroll people some time to calculate everything, where you could have worked something. Even if you do get paid December 31st, you might have an accrual for the work in the last week.
Exactly. So let's say you got a worker who earns $200 a day, and by December 31st, they haven't been paid for 5 days of work. Maybe they've also earned a couple days of vacation pay. And they also earned a vacation. Yeah, that's nice.
Vacation.
Remember, I got my first paid vacation. That was awesome. So, and then maybe a $150 bonus. Well, what the concept is here is even if you're not going to pay these amounts until January, you want to debit all the expenses in December, in this period. So the 5 days of wages, the bonus, the 2 days of vacation. And then we need to credit some account. If we're not going to actually pay the cash, we don't want to credit cash. We want to credit just some sort of payable account here. And then we jump ahead to January when we actually will then pay our employees, or maybe they take their vacation. Then this is very simplistic. They might not take the vacation until later, but the simplistic way when we no longer have an obligation to them is when we debit the payable and then credit the cash.
Yeah, and so this one, I'm just going to expand a little bit on the bonus expense. And the way that I've seen this done is that at the end of the year, the executives, basically the entire company, they make an accrual for what they think the bonus is going to be, but that's not official until the board of directors actually approves that bonus amount. And so this is a pretty big guess for people to figure out what is that bonus expense, but at the same time, it's for everything that was done in the previous year. So you're not able to just, we'll wait until the board approves it. You have to make some sort of bonus accrual.
You can reasonably estimate it. So
in the previous year.
That's great insight, man. Appreciate that.
Yeah, I went through that. It was actually a big deal. One of my clients.
Oh, nice. Nice. Well, payroll taxes, this is kind of a newer topic. A lot of these other topics we've been through before in the previous lessons, but payroll taxes is newer. And what the concept is that employees have certain deductions that need to be withheld from their paychecks. Payroll taxes is one of those. Social Security taxes, the first 6.2% of your wages you have to have withheld and remitted to the government for Social Security taxes. Medicare is 1.45% on that. There's no cap on Medicare. Social Security is taxed, is withheld on the first $128,400 of your income. Medicare, there's no cap. And then the employer must match those amounts as well. And we're going to show you an example coming up about how that works. There's also federal and state income taxes withheld, health insurance, retirement savings. What else do you have taken out of your checks? So, dental.
Dental, I guess.
Could have
vision
some charity
insurance
taken out.
Sometimes. Oh, yeah. Vision. A lot of companies will do charity if you're donating.
Disability.
I was just wondering, are you getting excited about payroll taxes?
Do I get excited about them?
Because you're more of a federal tax guy.
I don't get
international
too excited
tax,
about
right?
it. So, do you get excited about them? You can do this one if you want.
No, I do not get excited about it. Do you get excited about that coming out of your payroll?
No, not really. So payroll taxes, let's say an employee earns $1,000. The employer's got to withhold payroll taxes, $100 of federal income taxes, $50 of state, $85 of health insurance premiums.
That is a lot to keep track of.
It definitely is, and that's just what happens. That's why companies have payroll departments.
Yeah, or a lot of companies outsource payroll to someone who can keep track of all these different laws and everything, and they'll be the ones who actually do all the recommendations. So
exactly. So what you would do is you would have gross wages of $1,000 for the employee. Then you take out Social Security taxes. That's 6.2% of the $1,000.
That's good mental math.
Appreciate that. So you kick out Medicare, 1.45% of the $1,000. Now you got the federal income taxes, the state income taxes, the health insurance premiums. and then they would only take home $688. So, and that's very real. That especially once you start to get your first full-time job, and have to have health insurance taken out and make enough money that income taxes apply. Your take-home pay is a lot less than gross wages.
When you were creating this example, Boz, did you try and choose a reasonable federal tax rate and state income tax rate? If you were to annualize the gross wages of a grand
tried to
over
choose
a year?
something that was half reasonable, yes.
That's a tax guy for sure.
That's a tax guy.
But, it's good for you guys to see this too, even outside the accounting side.
Ooh, all right. Well, appreciate it. So
good work, boss.
That's right. Well, the journal entries on this one, why don't you take us through these?
So as a company, we are first going to start by debiting our wages expense, because that is what our company is going to end up paying. Not the same that you're going to get as an employee, but still what we have to pay. We're going to do a credit to payroll taxes withheld and payable. That's including both our Social Security and Medicare, just combining them together. Have a credit to income taxes withheld and payable for the state and federal amounts. Credit to health insurance withheld and payable for $85, and then credit to cash for the $688.50. So what you'll see here is that this cash piece that you're looking at, that's what the employer or the employee actually gets. These amounts are withheld on behalf of the employee, and then we are going to have to pay that out. If we're the employer, we're going to pay that out to the insurance company or the federal government or the state government, just depending on what it is. So additionally to that, the Social Security and Medicare is a matching
That's
tax.
what I said on the previous slide. Yeah, they've got to match this. So this is an additional cost to the employer.
Exactly. So not only does the employee kick in $76.50, the employer also kicks in $76.50, where we have a debit to payroll tax expense and then a credit to payroll taxes payable. Whew. That's a lot. It's a lot in just one entry, but hopefully by looking at the previous slide, you can see it's not so bad to calculate everything, and then it's really mostly just adding the word payable at the end of it. So total expense for the company then, the $1,000 that they pay in gross wages plus the $76.50, which is their matching portion for Social Security and Medicare. All right. So now when we actually pay it off, on the other hand, we are going to debit all of those payables that we had established. Debit payroll taxes withheld and payable, debit income taxes withheld and payable, debit health insurance withheld and payable, debit payroll taxes payable, and credit cash. And so really with our payroll taxes entry, or I guess our payroll entry, we have the initial one where we credit cash for what goes to the employee. And then after we accumulate that over the course of a month or a quarter or whatever it is, we make this entry, which shows all those amounts that we were withholding on behalf of the employee and that we had to kick in, we remit to the health insurance company or the government.
Yeah, so the total amount of cash the company end up pays out is, in this case, it'd be $1,076.50. The $1,000 to the employee, and then the extra, the $1,000 that the employee earned, and then the extra $76.50 they had to match. All right, unearned and deferred revenues. Again, we covered this one before, just as in previous lessons. As
Throwback,
simple refresher. When a company receives cash before it delivers goods or provides services, it has to set up what I refer to as a temporary liability account, because they have an obligation to do something, deliver goods or provide services. So let's say Boeing gets $100 million from Delta for a Boeing 737 plane to be delivered next year. This is way too simplistic, but we'll just run with it.
Gets us started, right? They're going to be happy. They're going to debit cash for $100 million, and they're going to credit unearned revenues. And then once they actually do deliver the plane, build it, do everything in the next year, they're going to debit unearned revenues and credit revenues.
All right.
And they'll be done.
Yep. Accrued warranties, we didn't really touch on those too much before, but what that is that many companies offer warranties on products they sell. If the product is defective, the company will fix or replace it, and then usually have a cash expenditure to do so. But you need to record warranty expense at the time of the sale, not when the warranty claim is made. And that's because you have an expense related to the warranty because you sold a product. So we want to match up that anticipated expense with that sale.
Same matching expense we were talking about early with accruals. Yep.
Yeah. So we'll just, an example with Toyota, they provide limited warranties whenever they sell a vehicle. So let's say every time they sell a Camry, they estimate a warranty cost of $800. So at the time of the sale, they would
debit their warranty expense for $800, credit accrued warranties for $800, thinking, okay, I'm going to have to pay that at some point. I don't know when, but at some point. This could be either long-term or short-term.
Yep.
And then they're going to go ahead and debit accrued warranties and credit cash for the $800 when they do actually have to make a payment under that warranty.
And we say making a payment, I mean, that might be when someone takes the Toyota car to a dealership and they actually have to, then Toyota corporate has to pay the dealership in order to fix that part on the car. So,
very realistic example.
Well, thank you. So the short-term debt, or it's sometimes called current portion of long-term debt, companies frequently borrow funds with payments due more than 1 year away, so that we initially record them as long-term debt. But then when that long-term debt suddenly is going to become due in less than a year, we need to reclassify it as current. And then let's say an example here, Walgreens borrows $2 million on a 5-year loan to construct a new store.
All right, so when they first borrow the money, they're going to go ahead and debit cash for $2 million. And then they're going to credit their long-term debt for $2 million, because at that time it is long-term, right? It's 5 years away that they have to pay it.
Yep.
Now let's say 4 years have gone by.
Like for the next 3 or 4 years, nothing changes, right?
No,
so you made that entry and then it just sits there for a few years. Sorry, I interrupted you.
No, that was the right thing to do.
Back at you, sir.
All right, so let's
it.
say now we are, in year 5 and it's going to come due in a few months. So what they're going to do is debit long-term debt and credit the current portion of long-term debt. And they're not paying it off right now. They're just reclassifying it on their balance sheet so that investors know, oh, that's current. They're going to have to pay $2 million within the next year.
Yeah, and if investors can look at that, and if the company has no way to pay that off, that could be a risk. The company might go through bankruptcy or something. So that's why investors need to know the current portion.
Absolutely. And so next up, we have leases of fixed assets.
I'm going to let you handle this one.
Yes, please do. So, there's some new lease accounting standards that have come out. And so this one, I guess leases could be either short-term or long-term. And depending on if it's a long-term or short-term lease, that depends on how you treat the accounting as far as recognizing a liability versus an expense. So in this first case, let's just say we have a short-term lease. If it's short-term, it's going to be classified as operating lease, meaning just each year you record an expense. If you have a lease and it expires at the end of the year, then you just record lease expense or rent expense for the year, and you're done. Credit your cash. You don't have to worry about it. If it's longer term, so greater than a year, it's going to be accounted for as a fixed asset, meaning you're going to debit an account called leased assets or leased equipment or something like that, and then you go ahead and credit lease payable. And that's going to, over time, it's going to reduce, and it is pretty complicated. We're oversimplifying right now, but what I want you to know about this is if you have a long-term lease, you should capitalize that on your balance sheet and create an account called lease payable. So you'll learn more about this in your intermediate accounting courses. You don't have to worry about it right now, but just the baseline is what we want you to get out of it. How'd I do?
I don't know. I took a nap for a minute. So
it was riveting. Huh?
It was riveting. I'll let you talk about leases. So it's all I can do to keep up with the new tax law. I'll let you keep up with the new lease standard.
The new everything else?
The new everything
else. That sounds great. Right. Boz, new tax. I'll do everything else.
That's right. I'll talk about contingent liabilities. I like these because I've been studying one company in particular we're going to talk about. So companies can face lawsuits, and the question is when to record anticipated expenses and payments. Now, if the payment is probable and can be reasonably estimated, then we're going to record the expense in our financial statements.
Estimable. Fancy word.
Estimable. I don't know if I guess
you don't need to. Reasonably estimated is correct. It's estimable is a fancy way to say it.
Yeah, big vocabulary. If payment is probable but can't be reasonably estimated or estimable,
hey, there you go.
We're going to disclose it in the footnotes. Mm-hmm. If payment is only reasonably possible, then we are not going to record the expense, but we're going to disclose it in the footnotes. And then if the chance of payment is remote, we're not going to do any recording or disclosure at all. So an example to go through, and I do a lot of speaking on ethics as well, and this is a case I've been following for years. Walmart paid bribes to government officials in Mexico in order to help them generate business, basically to open up Walmart stores more quickly.
Yeah, expedite the licensing and the permit process.
Yep, that's very illegal. It's a violation of the Foreign Corrupt Practices Act, and they're subject to fines. So for many years, they disclosed it in their financial statements, but didn't record an expense because they did not know how big the fine was going to be or how likely it was going to be.
And so the U.S. government is leveling the fine.
Yep, I heard one rumor the fine was going to be as high as $5 to $10 billion. No, it ended up their fine was only $283 million, but they couldn't actually reasonably estimate that until this most recent year. So they've disclosed this in the financials for several years, but now in this most recent year, they actually accrued the fine because now they must be, reaching some sort of settlement with the government. So in their financial statements this year, they're going to debit some sort of fines or penalty expense, credit fines and penalties payable, and then when they end up paying this off, probably over the next year or two, then they're going to get rid of the payable and credit the cash.
Yeah, and at this level, this example is pretty straightforward, but in actual practice, this gets pretty complicated as far as usually lawyers don't want to try and estimate an amount of a loss, and usually they don't want to say, we're probably going to lose this
guilt,
one.
Maybe, or
exactly,
right?
And they're very sensitive about that, and so this is an actual tricky one in the profession that accountants deal with quite a bit, pretty much around every reporting period.
Exactly. So additional long-term liabilities. There's a concept we saw it on the balance sheets, deferred income taxes. Those are recorded in order to match income tax expense against financial statement income.
It comes up again.
It does. It does. These are just about as complex as any area of accounting, I think, and you'll see those more in an intermediate course or a tax course. There's also pension liabilities. We saw Boeing had some large amounts, and that's just a company. They may promise to pay, former employers or retired employees a set amount per month or year for the rest of their lives. They may give them a cash payment. They might also pay health benefits.
Sounds like a great deal.
It used to be really popular, and then companies realized that this is a massive liability they carry. So normally companies provide benefits now that are shorter term. They might match someone's retirement contribution as an example, and then they just make that payment in the current year, and then they're done with it. So as opposed to having some massive pension liabilities on their books. How much did Boeing have?
If you combine the health care and the pension plan amount, it's about $22 billion.
Yeah.
$22 billion is what it's underfunded because they're putting money into this account to hopefully help it invest and grow. But it's underfunded by about $22 billion right now. Yeah,
so companies aren't doing this a whole lot anymore for current employees or new employees, but it used to be very, very popular. Mm-hmm. The last really liability that we wanted to get into was notes payable, and this is something we covered in lesson 4. But so we just remember a company may borrow from the bank to fund certain needs. And it would do so with a formal written note. It's going to have a repayment schedule, specific dates and interest rates. And when you borrow, you're going to debit the cash and you're going to credit a notes payable.
Not too bad, right?
No, not bad. So let's go through an example, and we'll do a simple one where we don't cross a year end. And now these are normally companies borrow for the long term. We're going to show a couple examples that are less than a year, just to keep it a little bit more straightforward. So let's say a company on March 31st borrows $10,000 at a 10% interest rate and has to make payment 6 months later. What are you gonna debit and credit here?
Well, I don't have to stress about the mental math at this point because I got the answers up in front of me. But
right.
So initially, March 31st, when we borrow the money, I'm gonna debit my cash because we're getting $10,000. I'm gonna credit notes payable, not accounts payable, because again, this is more formal, defined payment period, interest rate, things like that. Mm-hmm. Then when I actually pay it back on September 30th, I'm going to debit the note payable, so I'll pay the cash for that, but I also have to record the interest expense at this point. So I'm going to debit my interest expense for $500, which is the $10,000 that I borrowed times the 10% annual rate, but I didn't have it for an entire year. I only had it for 6 months. So I take $10,000 times the 10% times 6 over 12. Then if I add those up, it's going to give me my credit to cash of $10,500.
So that's the more straightforward way. Sometimes notes cross a year end or a period end, and then we have to accrue interest expense. So how about if the same facts, except instead of repaying 6 months after that March 31st borrowing, let's say they're going to pay back a year later. So the first entry is the same.
The same. There's no change in that first one.
How does the second entry change?
Well, December 31st, we've been talking about that matching principle. So we have to record an expense because we've had that benefit of getting the cash. In theory, we've used it to buy inventory or equipment or something that's generating revenue for us. And so we have to record an interest expense because we've been using it. So we'll debit interest expense for $750. To get that, took the $10,000 loan times 10% times 9 months of
now it's
buy
9
in this
months.
case.
Yep.
And so debit interest expense, and we're going to credit interest payable because we haven't paid it off yet. Now when it comes up to March 31st of 2019, where everything is due, we're going to debit the notes payable, get rid of that. We got to pay the full $10,000 no matter what. We're going to debit our interest payable for $750, and then we only have to debit an extra $250 for interest expense. And to get that, we had already recorded 9 of the 12 months on December 31st, but now we have to record the extra 3 months on March 31st.
This is from like January 1st, 2019 to March 31st, 2019.
Exactly. So January, February, March. And then we're going to credit cash for the total amount of $11,000.
And it balances, and we're happy.
But life is good.
That's right.
We're balanced.
Well, those are liabilities, and now we're just going to introduce the concept. We mainly are introducing the concept of present value because that's going to be useful in tying into our kind of our next lesson coming up, lesson 9. But we're going to tease you a little bit with future value. So many transactions involve paying or receiving money in the future. Because companies can earn interest, the theory is that $1 today is worth more than $1 in the future. So, for example, you'd rather have $100 today than 1 year from now because you could take $100 today, and if you could invest it at 1%, you would have $101
Woohoo,
a year
rich.
from now. That's right. Again, an extra dollar is not a lot, but put a few zeros after this, or in periods where interest rates are higher, and this makes a big difference.
If you give me $1 billion, I'll live off 1%.
You'll live off 1% of the billion,
Yes.
$10 million. So
Yeah, that'd be okay.
Yeah, you could do it. So, but conversely, a company would rather pay $100 a year from now and not today, because the theory is if they could only get a 1% interest rate, they could set aside $99 today, invest it for a year, and then pay off $100 in a year.
This math doesn't quite add up.
We're
guys.
off by a penny on that one, so but
We are.
you're gonna let me roll with it just this time.
I am. But the whole idea with
Yep.
that is the present value one. The idea of what does it take today to get that $100 a year from now? That today amount is called the present value.
Exactly. So future value of $1. What the formula is the current amount multiplied by a factor is going to give you your future value. So let's say you've got a first-year college student. That's a big audience for these. They're 18 years old. What if they set aside $1,000 today and just a one-time $1,000 payment? It's going to grow for 50 years, and let's say it can grow at a 10% interest rate. Well, in order to figure out how much they would have...
That's a long time, but it is realistic.
Yep. In order to figure out how much they would have, what we can do is we can go to a chart right here. These are available online. You would usually do this in Microsoft Excel, but...
Yeah, we have an Excel series as well. It's where we recommend doing this, but this is a way that gets you the right answer and helps us explain the point for this video.
Yep. So we've got a lot of factors up here. But in order to identify the proper one, 10% in 50 periods. Whoa!
Did you see that animation?
I did. You did that.
That's pretty cool, man.
I was pretty excited.
But what you see happen here is to use this chart, we found the rate per period comes over to 10%. And then down on the left side in the column, we have the number of periods. We said it was 50 years. So 50 years, 10% all the way down, comes out to 117. That's our factor that we're going to use.
Exactly.
That's pretty cool, man.
Great work, man. So then we use that 117.3909 factor, multiply that by the $1,000 investment, and you just put aside $1,000 and you ended up with 117 grand. And that, basically 116 grand, almost all that you end up with is interest, the power of compounding.
So what if, instead of just doing a one-time thing, I invest $1,000 every single year?
I bet you're going to end up with more.
You think so?
I think so.
Well, I'm putting in more, so I shouldn't I?
That's theory. So
right.
Let's find out what it's going to be. So that
we can calculate that. Look at that.
We can. It's almost like you knew this is coming.
And that's what an annuity is, everyone.
A series of equal payments is an annuity. So what you do if you're trying to compute the future value of an annuity is what is the amount of these equal payments, multiply it by a factor, and that'll give you the future value of the annuity. So let's say you looked at that previous example, you said, that's cool. I'd like to set aside $1,000 and get $117,000. What if I do this 50 times? Now you can't just multiply that $117,000 on the previous slide times 50 because, especially some of your last payments, they're not going to have much time to grow. So what you need to do then, go to a future value of an ordinary annuity table.
It looks the exact same, just slightly different factors on here.
10%, 50 periods, and now we can see our factor is 1,163.
That's the factor.
That's the factor. So that if we multiply that by our $1,000 annuity payments, we've got over $1.1 million. We only put in $51,000 annuity payments, and you've got $1.1 million of interest earned.
I'll take this one.
So hopefully right now, everyone's just like shutting off the video and going to put $1,000 in.
Oh, just put it in the market, something cheap,
right.
Not going to cost you a lot of money, no transaction costs.
Exactly.
Let it sit.
This is real. We know why you talk about investing early and investing often.
And yeah, well, we talked about before the companies with the pension plans. Now they've gotten away from it, so they're encouraging everyone to invest much money as early as you can because it'll grow.
Exactly. So in accounting, we work more with present value factors.
I think they're hooked now, though.
But that's why we did it. We did it for the hook. So present value of $1. If you want to figure out a future cash payment that you have to make, what is that worth in today's dollars? You take the future amount multiplied by a factor to get a present value. So let's say a couple expects to pay $30,000 5 years from now to purchase a new car, but maybe they've got some money today and they just want to set it aside and they think they can earn 6% interest. How much would they have to set aside today?
Yeah, car's still working. They don't want to save anymore. They just want to set it aside. What do they need to get up to $30,000 in 5 years?
Exactly. So in that situation, they said maybe they can invest at a 6% interest rate. We go down to 30 periods and we get, 5 periods, not 30 periods. We get a factor of 0.74726. And we use that factor and multiply it by $30,000 to get a amount that we have to set aside today of a little over $22,000.
That's not bad. I can pay for that $30,000 car if I put aside the $22,000 today and kind of let it grow.
Yeah. So $30,000 balance, you subtract off the $22,000 we gotta invest today, and we would basically earn $7,500 of interest. That would help us make that
25% of my car is covered just because I invested for it today.
Exactly. You want to take the next one? What if you're going to get a series of payments?
Well, yeah, I do, because we
this
use
is
for our example the lottery.
Yeah.
What do you do if you win the lottery, Boz? That's the question.
I don't know what I'd do because I don't play the lottery, but I'd give it all to you.
I play. Thank you. I'll take it.
That's great.
You heard it here on video. I think that's legally you're obligated now. Yeah.
So.
All right. So present value of an annuity. This is one where you're looking at multiple payments. So it's an annuity, meaning annual, right? We have future annuity payments multiplied by some factor would give us the present value of that. We're looking at what do we need today? What single amount do we need today to create a series of payments down the road? So with our example, if you play and win the Powerball, you have the option of $40.6 million today, or $2.37 million per year for the next 30 years, which comes out to $71.1 million. That's the number that they advertise for the Powerball.
Yeah.
So using present value, we're going to be able to figure out what should you take, the lump sum or the annuity amount. So here, you believe in appropriate...
Reality is everyone would just take the lump sum, but we'll just show what they should consider.
What they should think about,
right.
Yes. I'm taking the lump sum, that's for sure. So if you think you can get a 3% interest rate, what option do you choose? And for this one, we look at similar chart. Notice it's present value of an ordinary annuity, not just a single sum anymore. And through 3%, 30 years, we have a factor of 19.60. So if we look at that factor, again, here's our problem. We see 2.37 million times 19.6 gives us $46.5 million. And you can see the answer is choose the annuity option. All right, so what we see here is that if we receive a lump sum, we get $40.6 million. That's the present value of option one, $40.6 million. Well, using our chart and a 3% interest rate, we calculated the present value of all these annuity payments as $46.45 million. So essentially, we took something that's an annuity, what's happening over the next 30 years, and brought it back to what is that worth to us today, one single amount. And so if the appropriate rate is 3%, then yes, we would choose the annuity because that present value is $46 million versus they're offering us a lump sum of $40.6 million.
Yeah, what it means is getting the big lump sum up front doesn't mean as much to us because interest rates are so low we couldn't invest it and get very nice returns off it. We could look at how it's different in our next example.
And hey, look at that. Interest rate now is 8%. That's a little bit more realistic. If you invested in the market, S&P traditionally returns 10%, minus 3% for inflation gives you 7% annual return. What do you choose? Well, in this case, we're going to be in the 8% column. Did you see that animation?
That was beautiful, man.
Let's just do it one more time.
I'm very proud of you. Very proud
Put
to
in
know
the
someone who
the
can
sound
do that.
too. Yes.
That's right.
So we have the 8% animation over 30 years. Now our factor is 11.25. So if we look at this and do the math on the bottom here, 2.37 million times 11.26 gives us 26.68 million. That's not a very high present value. So what we would want to do in this case, take the 40.6 million, invest it on our own, and at an 8% rate, we'll get more money than if we had just taken that annuity.
Well, that in theory means you could take that 40.6, invest it at 8%, and then if you wanted the 2.37 million annuity, take that out, and you'd still have money left over because the interest rate is so high. It's getting a little bit complex. We'll learn about that more in some future classes.
This is a lot easier too to see when you actually do it in Excel. So watch our Excel video on it.
That's right. So key takeaways from this one, we'll wrap it up. So liabilities, they're recorded when it's probable that a company will need to make a payment or provide the goods and services, and we're, in general going to be matching them against financial statement income.
Lots of different types. We just got to be aware of the general pattern and then apply it to new types that pop up.
Yep. Second one, the future value of a dollar is worth more than a dollar today just because you can invest that dollar that you get today.
Remember, my $100 turned into $101 at the 1% interest rate.
Yeah. And then present value, future cash flows, that's less than the future amount of that cash flow because, once again, you can invest those amounts. I don't know. That's about all I've got today.
Man, this is a long one, but there's a lot of different examples in here, and it's cool stuff. So wish we could speak longer about it.
That's right. So someday we will.
All right. Thanks for tuning in, everybody.
Take care. Bye-bye.